How's it going? It's great to be here today. My name is Nick Angeramo.
Max Holden. Oh, I think Nate might have some audio issues, but Nate's in the back, and yeah, we're the Dartmouth Energy Alliance.
And we're here to present to Macquarie and the Green Investment Group our MIT Energy Hack proposal.
Yeah, so starting off with the current situation, really having these proliferating debt equity ratios. The government subsidies are essentially disappearing, and the PPAs are really shortening their time length. And then the market prices are not really reflecting the intrinsic kind of value that renewables should bring to the table.
So right here is a projection from the Resolve project of CAISO via the California Public Utilities Commission. And currently projections are showing an increased merchant risk for renewable and energy storage assets participating in the wholesale electricity markets. And this is shown in the model by the increasing debt fraction over time from 2020 to 2050. So a key takeaway from this is that we need to lower the rate of debt equity ratios and reduce the merchant risk.
Not sure we can hear you, Nate. Okay. Yeah, so what needs to change from the current model? Just go to the next slide. Yeah, so starting off with volatility, that's a big problem at the moment. And we're going to be addressing kind of head on with looking at the pricing and then using the tools of, marketing policy and market design. And then going towards reliability, yeah, exploring storage, whether that's, pumping or actual batteries itself, and looking at tax equity investments to stabilize these. So starting off with the volatility, we're still really going to be using conventional or thermal units as a parameter for the price, and then looking at batteries, that's really going to help us stabilize these stock curves in the near term, and then prices in the long term. And one of the main factors that everyone needs to focus on is really looking and not underestimating the cost of replacing these batteries. Usually, they last a little shorter in time length compared to the PPAs, so not underestimating the cost for replacing those. And then really minimizing the increasing rate of the debt equity ratio for storage over time.
When it comes to reliability, we think that we need to develop tax incentives. So this would be extending tax credits for renewable energy projects that are currently in place, as well as introducing battery-specific incentives. And we think that this is integral in order to continue the tax equity investments that are currently happening in the market, which really lower the capital cost upfront of the project.
Yeah, and we want to discourage as well kind of the production of those thermal units by adding some, carbon tax or to essentially levelize the playing field even more, both looking at a social as well as financial aspect. And then we want to introduce auto building into energy markets using AI, using past data from not only the US ISO markets, but also international. Looking at markets in Europe, they've already kind of looked into and applied these batteries in terms of storage, and we can learn something from that.
Something that's integral to reliability is to manage your risk. So this would be done by continuing to hedge and utilizing capacity contracts.
Yeah, and so in sort of wrapping everything up in a nice package, I think that we're really trying to focus on batteries as a stabilizing measure for prices in energy markets. We see batteries as a way to combat the issues associated with the duck curve, and also as a way to better ensure stability in markets.
Nick, I'm not sure. Yeah, so I guess we'll go on to AI bidding. We already kind of went over levelized cross structure, just really looking at using that full potential of the batteries. We can go to the next slide maybe to finish off.
Thanks, Dartmouth team. Time is up. Let's start Q&A session.
Okay, I will stop sharing then, and if that's okay.
Yep, cool. Thanks, guys. And I do have your slides up on my end.
Okay, perfect.
One question, yeah, just one question a bit. So you're looking to lower the debt to equity ratio, and this is on a project basis, right? So I go out, I build a project, I'm financing that with debt, I'm financing that with equity. You know, there's that debt to equity ratio on a project basis, and you're saying that you'd be looking to lower that. Can you explain that a little bit more?
Yeah, sure. I mean, we're looking we think that by reducing the merchant risk, the debt that's going to be contributed to the project would be lower, and that there would be more investor equity that would be invested into the project.
Okay, how does that impact your ability to lever the project? Just because I mean, usually the cost of debt would be lower than the cost of equity. So there is an opportunity for leveraging if the debt cost is lower than your equity.
I think that's what we're intending to do. Like through our slides, it was really showing that the debt fraction was increasing. It was projected to increase over time. So we wanted to keep that low. One thing we didn't really get to at the end of it, but we wanted to keep that debt fraction low so that our equity was higher than our debt.
Got it. Okay. And then, sorry, I'm just pulling up. I had your slides here. Talk to me a little bit more about automated trading. I guess why you think kind of going towards automated trading would help reduce risk, and maybe views on kind of what the long-term impacts of that would be if you have a whole lot of market participants moving to automated trading.
Yeah, I think using AI basically just to get more data from not only, you know, if you're looking at one market, like let's say, for example, in New England ISO, getting data from other markets internally within the US and then also externally, they might have a bit more, I think, experience in Europe with introducing batteries, since it's kind of like they're just now really introducing that. They've had hydro there for a while, but understanding like the reactions within price fluctuations over time on the long-term impact, since we don't really have too much experience with that. I think it would also lead to this bit more efficiency as well, in terms of like risk-taking, that the people are, you know, buying electricity on a daily basis.
Got it. And then one question, as far as kind of looking at the solutions you proposed, is the financial model I'm seeing on page 3 and page 9, was that a model that you built to kind of compare different options, or was that the model taken from the California Public Utilities Commission? And if it was, did you do any internal modeling to kind of look at some of these ideas?
Yeah, so the model that we included in our slides is based on that from the California Public Utilities Commission. We basically looked at the data provided in the model, and then based on the projections of the California Public Utilities Commission in their resolve model, we sort of tried to weigh the effects of our projections and then develop a just sort of like scaled model, which you see on slide 9.
Gotcha.
The key difference is on
Okay.
slide 9, we kind of showed that the debt equity ratio would be stabilized as the years went on. It's kind of a subtle change to see because it's so zoomed out.
Got it. Okay. Okay. Cool. Were there any specific kind of tax policies that you would recommend? Any kind of specific structures or things that you're recommending on that line?
And one thing we definitely recommend on that line is to introduce a specific battery related tax incentive instead of just a battery one that would have to be attached by an existing energy system. And we think that could really stimulate the market.
Thank you, Dartmouth team. It's time. We move on to the next team. Thank you.
All right.
Cool.
Thank you.
Hey, thanks, guys.
Appreciate it.